Good morning, everyone. Welcome to the City of Grand Prairie's 2019 budget discussions. Great to see everybody here and ready to go. We've got a full house this morning, and I think to kick off our day, I'm going to look to our interim city manager, Mr. Horacio Glante, for a bit of a brief introduction of our first guest that we're going to have this morning.
Thank you, Mr. Mayor. Good morning, everybody. The first session of this multi-day budget deliberation is a presentation from CIBC Grande about economic forecast. So here in the room we have Mr. James Hobson, investment advisor and portfolio manager, and Mr. Richard Shahal, investment advisor with CIBC. They will use the first hour of the presentation to give us a global, national, regional economic forecast. And following that, Mr. Brian Glavin, our Deputy Director of Infrastructure, will present Grande Prairie and Region Economic Forecast. Thank you.
Thanks, Mr. Glante. Gentlemen, welcome.
Thank you very much, and good morning, Mayor and Council. Thank you very much for having us here this morning to present you with an economic update. We're hoping this can add a ton of value for your budget decisions today. So basically, I'm not sure if we have the slides up. Perfect. So we're going to start out just as a broad overview, just to give you kind of the theme of this presentation. We're entering sort of the mature phase of the business cycle here in Canada. So basically what that means is we're still going to have positive growth, but it's going to be slowing positive growth. So things are going to continue to expand into 2020, but the rate of expansion is going to slow. And that theme is true both in Alberta, Canada, and also globally. So just as sort of a quick agenda for us this morning, we're going to start out local. We'll cover some sort of provincial data, how we stack up against the rest of the country. We've got a little bit of information on Grande Prairie specifically for you. We'll go through just Canada as a whole, sort of the growth environment, the employment situation, and the housing environment. We'll give you a quick update on the currency and interest rates and a little case study on inflation. I think that's very relevant right now. And then I'm going to pass it to Chart. He'll walk you through oil and gas. There's a lot of interesting things happening in that market. And then just a bit of a global and US update. So if we start locally here, if we look at Alberta and how we stack up against the rest of the country, the good news is that Alberta and BC are forecast to top provincial economic growth next year. This has been true in 2018 and also next year. Obviously, we're having solid growth because we started from a lower level after the sort of 2014-2016 recession. But things are still looking bright, and obviously, challenges aside. Across Canada, all provinces are expected to grow for the next 3 years through 2020. Again, we are at sort of the mature phase of the business cycle, so those growth rates are in the sort of mid-twos right now, but they're expected to slow into the single digits, sort of low ones by 2020. And Alberta's unemployment rate, things have improved since sort of 2015, but we're still sort of hovering around that 6.5% level, just a little bit above the national rate. So this chart here just shows sort of the real GDP and unemployment rates for all the provinces across Canada. As I mentioned, in 2018, Alberta is forecast to grow at 2.4%, just above the national average of 2.1%. Unemployment rate just across the province sort of down from last year's 7.8, which was pretty rough, to 6.6, and then coming down a little bit to 6.5 next year and leveling out after that. Now, I'll go into it in a bit more detail later, but there's a lot of divergence across the province in terms of where the unemployment rates are. And the good news is that Grande Prairie stacks up very well against other regions. It actually shines ahead of other cities and areas. So what we've seen in 2018, broad-based strength in business activity. Firmer oil prices helped that, although the significant transportation bottlenecks in that market are continuing to hinder us. Chart's going to get into that a bit later here. Oil production and demand was much stronger than originally anticipated that we forecast last year, so the GDP numbers are tracking higher than we previously expected. As I mentioned, transportation bottlenecks are a big challenge for us. That's not going anywhere. And then the labor market continues to advance, so I'll walk you through sort of what's happening here in Alberta and Grande Prairie and how we stack up compared to the rest of the country. So the good thing is the chart on the bottom left there just shows sort of Alberta's employment situation. The green is part-time and the blue is full-time. And what you'll notice there is in sort of since the middle of 2017 through now, we've seen a big rotation away from part-time employment towards full-time employment. This is a positive sign. Those jobs are generally higher paying, they're stickier, people stay in them longer. Obviously, seasonally, there's less hiring in July, but generally the trend has been positive on the employment. And then on the bottom right there just shows Alberta's oil production tracking way ahead of forecast, which we want to see. So one thing that's topical for the labor market is that we're starting to see labor shortages emerge for the first time since sort of 2014. So for a long time during the recession, it was really easy to find employees. You could basically just post jobs and you'd get 100 applicants for them. Now that's not the case, and we're starting to see some labor shortages. So if I just jump ahead here. The chart on the bottom left there just shows the labor shortages per province. You can see in Alberta, we had a massive drawdown during the recessionary years, but that started to turn at the start of last year, where we're actually starting to see labor shortages emerge. This can become a challenge for municipalities who are looking to hire good talent, because generally you just have to pay more to get good talent and to retain good talent. So the situation for employment is improving. We're starting to see wages increase to the point where they're competitive across in terms of how we stack up against other provinces. And then we're also getting, on the bottom right there, the chart just shows interprovincial migration. Now, we came here a year ago and forecast the same thing, in that we're starting to see people come back to Alberta because of the economy. So you can see, again, there was a big drawdown during the recessionary years, and now we're seeing people come back to Alberta basically just for the jobs and the more affordable housing. And interestingly enough, you can see BC is that yellow line. They've started to see an outflow of people from the province just because of crazy household affordability. It's really hard to buy a house in BC. So if we look locally in Grande Prairie, as I mentioned, Grande Prairie as a region sort of stands out. Calgary is by far the toughest market right now for jobs. Edmonton is sort of in the middle there. So in the Red Deer, Wood Buffalo, and Grande Prairie regions, these are sort of the bright spots across the province, where we're seeing sort of the trend diverge and jobs come back to sort of more normal levels after the recession. And this map here just kind of illustrates that point. It shows unemployment rates in the different regions. Now, obviously, the region we have here for Grande Prairie is pretty broad, but to give you a sort of a general sense, unemployment rates are around 5.3% versus Calgary at 8.2%. So Calgary really has been stuck in that sort of 8 range. Edmonton sort of around the national average of 6.2. In terms of housing here, sort of across Alberta, it's been pretty slow. But again, Grande Prairie's been a bit of a bright spot for housing because employment has been improving. Also, housing sort of follows that trend. So we've seen the average home price in the region improve a little bit over last year. And we're sort of closing in on those price highs that we saw in 2015. As I mentioned, it's one of the few reasons we're sort of getting back to that pre-recessionary levels. And year-to-date home sales, so just the number of homes that are being sold, is up 22% from the same period last year, and actually above 2015, 2016 levels. So that's what we want to see as a continuation of that trend. And this here is just a graph of exactly that point. So this would have been at the end of last quarter. You can see year-to-date 2018, we've almost exceeded the 2017 full calendar year, and way above 2016. So again, we're not back to where we were in 2014, but we're back to sort of more normal levels for housing. Canada as a whole, it's been a bit more difficult. So higher borrowing costs, obviously, as interest rates come up. Stricter lending rules, so it's a lot harder to get a mortgage these days. You have to pass a much higher stress test to qualify for a mortgage now. Contributed to a pretty sharp drawdown in the Canadian housing market at the start of 2018. So as I mentioned, it's permanently raised that the bar for borrowing for housing. Now, we estimate that the mortgage renewals, I'll just bring up the chart here, is going to cost Canadians about $8 billion through 2020. Now, the good thing is that because employment has improved, households should be able to service that debt, but it is going to be a bit of a strain on their disposable income. And the chart on the left there just shows sort of the dramatic effect these new mortgage rules had on the Canadian housing market. You can see in the first quarter, housing sales were down 25.9% in Alberta, which looks pretty scary. But if you fast forward it till the end of July, it was really only, it recovered quite a bit to the point where pretty much flat year over year. Interest rates is what we spend a lot of our time focusing on in terms of managing the city's investment portfolio. So obviously the Bank of Canada has been hiking interest rates basically just to get ahead of inflation. We're kind of right at that target inflation rate of 2%. So it's kind of where they want to see things. They've hiked 5 times since last summer, so it's been pretty rapid pace. The good news is that we expect those rate hikes to slow down from here. So we think we may see a couple more hikes early 2019, and then the overnight rate settling down around that 2, maybe 2.25% range. So for your borrowing costs, you know, you can lock in lower rates now theoretically, and then on the investment side, your investment return rates will continue to increase as interest rates go up across the board. I'll touch briefly on currency because it's not such a huge topic, but basically the Canadian dollar has been an interesting story. It's outperformed most of the world, but it's underperformed against the US dollar, which is kind of shown in the chart on the right there. So the problem is that the US has been hiking rates faster than us. It's that simple. So you get paid more to hold money in US dollars than you do in Canadian dollars. So again, it supports the USD. From a Canadian dollar strength standpoint, the good news is as we continue to hike, there should be more strength in the Canadian dollar. But again, it's been a bit of a boring currency to watch. It sits sort of around that 78 to 80 cent range. And most of it is due to the Bank of Canada. They're pretty uncomfortable if it gets above 80 cents because it starts to impact our exports. So if you're trying to forecast, you know, purchasing things in US dollars for the city, expect that sort of 78-cent range. It's not going to go anywhere major. We don't expect a huge price swing on the currency. So just summing up for Canada, we expect a broader runway, so a longer runway, so to speak. So we had the big oil crash that sort of slowed us down, obviously. We've still got some issues on the transportation point for crude, but overall, we've got a longer runway. We don't see a recession in sight. So as chart we'll get into later, the yield curve is still positively sloping. So we don't anticipate a recession. Growth rates, however, will continue to slow. So we'll have positive growth, but it's just not going to be as fast as it is this year in subsequent years. The headwinds we have is it's just from a tax perspective, it's much more competitive to deploy capital in the United States. That's going to continue to be an issue for us. The good news is that because we've had strong population growth, that's the chart on the bottom left there, it's actually permanent, it's sort of structurally changed or increased our sort of natural long-run growth rate. So our productivity and our labor force have both increased, so that bodes well for the economy. Now, I want to spend some time talking about inflation because I think it's very relevant for your decisions over the coming day or days. I guess just to give you a quick update on where things are at now, we had a big overshoot in terms of the headline inflation number. The Bank of Canada targets 2%. It came in at 3% in Q3. So that looks like a huge overshoot, but if you look at it, the chart on the bottom right there, energy prices contributed almost a full percentage point to that inflation number. So it's what we'd call transitory. It's not going to stick around for a long time. So the bank's core measure of inflation is sort of firmly around that 2% level going forward. This year forecast at the sort of 2.4 range and then leveling off around 1.9 in the subsequent years. And I want to just talk sort of more broadly around inflation because it's become a pretty big topic when we're doing these council meetings across the province. The key, I guess just as a refresher, inflation basically just erodes the purchasing power of money. So as an extreme example, over 35 years, a dollar will lose half its purchasing power. And from 1950 to 2017, the dollar actually lost 90% of its value. So obviously that was a period in the 80s where inflation was really, really high. It's probably not going to be that extreme going forward. But again, if it stays at that 2% range, a dollar will lose half its value in 35 years. So it's something to keep in mind when you're looking at tax rates, because everything you do from a goods and services standpoint, it's going to be tied to inflation. So costs will naturally increase at a rate of at least 2% per year. Now, I want to touch on wage inflation because this is such a significant expense for municipalities, often in sort of the 2/3 of your revenue each year. So the graph here just shows the dotted line at the top shows Alberta's wage inflation. Now, Alberta's wage inflation, if you look at it from a 20-year standpoint, so 1997 to 2017, wages more than doubled in Alberta. They're up 108%. The average annual nominal growth in wages is 3.6%. So the dotted line is Alberta's wage inflation. You'll notice it's pretty much a straight line. The reason for that is it's way harder to cut people's pay than just fire them. So generally, jobs will just continue to pay more. The red line is Canadian wage inflation, and then the shaded area is just Alberta's general broad inflation rate. So it's a bit of a concern for municipalities because obviously the shaded area, that's your broad inflation, that's what goods and services are going to increase by. And then the dotted line, which is your wage inflation, they're expected to increase at 3.6% at a pretty stable pace going forward. So it's a big expense for municipalities. And I guess just to summarize, so in order for employees across the province to keep their standard of living the same, their wages have to grow at least the rate of inflation, normally more than the rate of inflation. And that's just to make sure that their purchasing power doesn't get eroded as goods and services just cost more. Now, the same thing applies to your revenues. If you think about all the revenues and the tax reserve that you have invested with us, every year the purchasing power of those reserves has a natural drag by inflation of around 2%. The good thing is what we're doing on our side is basically trying to maintain that purchasing power by growing at, say, 3.5%, which definitely helps. But in terms of your revenues coming in, they'll naturally be able to afford you less goods and services over time. So we think of it as sort of an intrinsic cost, whereby sort of if you keep your tax rates the same, costs will just keep increasing. So keep that in mind in terms of the purchasing power of those revenues and the reserve funds going forward. So with that sort of said, I'm going to pass it over to Chart to run you through the rest of the presentation.
Perfect. Thanks, James. So I'm going to start with talking a little bit about NAFTA update, or the rebranded, really awesome name of U.S.-Mexico-Canada Agreement. And the big wins for us on this side, I'll start with on the positive side, is there's 3 key pieces. The one is auto tariffs. There's something called the preservation of Chapter 19 dispute resolution. And essentially one last piece, which is the protection against U.S. demand for U.S. goods and procurement contracts. What all 3 of those points essentially mean, how is it a win for Canada? It's one key piece as our neighbors to the south keep playing this U.S. protectionism, U.S. first agenda. We're sheltered from that going forward in terms of tariffs, anti-subsidy duties, anti-dumping laws, any of that kind of stuff we're protected from. So he can keep playing his protectionist games that he's playing with the globe, but on our side, we're still protected on that front. Where we essentially got hurt a little bit was, as no surprise to anybody, was the dairy supply. 2 ways to look at this. There's 2 sides of this coin. From the viewpoint of the Canadian producers, yes, they had to give up a little bit because it's more competitors in the market. But from the consumer standpoint, it's a benefit just because there's a lot more competition in the market. So it just depends on what kind of side you sit on there. Overall, economically, more competition is not so bad in the market. So not that much to give up in the grand scheme of things. Next is costs. This is a potential cost just to keep an eye on. It's more in terms of healthcare. U.S. drug manufacturers got patent protection for an extended 2 years, so costs on healthcare could go up, but the impact of that is still unknown. The last piece is more so a little bit of an uncertainty standpoint. The aluminum and steel tariffs that they put on, and then we did our retaliatory tariffs as well. There's no resolution on that yet, but the good news is they are still discussing. They're all still trying to find a resolution to all that. The USMCA, they just wanted to come out and say, we have something, we have a good solid base, and then we can kind of figure out the fine details. Because the last thing you want is a Brexit situation, and over a year later, there's nothing decided, and you're still trying to negotiate. And we all know capital hates uncertainty. So dollars want to make sure that business investment makes one, like all that uncertainty stripped out. Now, the fun one, oil, especially in today's market. What is going on? Why did we just have 13 consecutive down days, wiping out almost 20% of our gains? Well, when I always talk about oil, I like to talk about the high level and just kind of peel back layers as we go, get a little bit more into the Canadian market as we go as well. One thing I like to remind everybody, fundamentally, global demand is still growing and outstripping supply. That normalization happened. That was from your $27 bottom to the correction of to $60, $70 that we saw. That was that normalization of global supply. So the global macro supply imbalance shifted over the last couple of years. That's one key piece takeaway, that the interim short-term outlook, which is what you're seeing on the news now, doesn't take into account or reflect. Right now, we have about 1.2 million barrels a day of growth in demand, which is outstripping the supply. Now, on the other side, now let's talk about what happened in the recent markets. Well, the main catalyst for causing that price decline was primarily one thing that kind of gave the market a shock. When the price of oil price of Canadian oil started to get beat up really, really bad in the market, the margins for those U.S. refineries got really good because the price of gas was really good on their side. So they were making a really good spread on their dollar over there. What that made them do is all these refineries started working harder and harder and harder and pushing way past their scheduled maintenance seasons. And when you do that, that means you have to go into maintenance for a lot longer than anticipated. Now what you're seeing in the market is that inventory start to get built up because these refineries aren't pulling it out anymore. That was a catalyst that caused the initial decline. We started to see those weekly inventory builds come out. That now you mix into the equation, we have some tweets going on down south that are supportive of lower prices, and because he wants to shed, he doesn't want to compete with OPEC oil. And on the other side, even from an OPEC standpoint, well, they cut a while back. They have an inventory build that they want to slowly start shedding as well. What the market needs to understand is they're not going to just flood the market with this inventory. They want sustainable growth on both sides. So yes, there is more supply, but there is demand to offset it. That's the big key piece. So the catalyst was that short-term shock, a little bit more volatility than anybody's anticipating. No one thought we were going to go from $70 to $56 today. Good news, up 2% today. So it was not a 14-day decline. So at least that record that we didn't want to set ended. Now, where do we think oil is going? Long term, I think we found kind of that sustainable pocket we're sitting in from anywhere from that $55 to $65 range. Really sustainable for global growth, global demand, and global supply. That's the really key piece. People can produce and still pull that oil at the same time. Now, let's peel back a layer and go on to this side of the border and what's going on with Canadian supply. Well, no news, shouldn't be news to anybody. There's no way out. Our Canadian infrastructure is kind of the big black eye on Canadian crude oil right now. The way to think about it is all the pipelines are full right now. Every single pipeline is full. And there's other pipelines that are coming online, like Enbridge Line 3 and Trans Mountain, all that kind of stuff is there. But the Enbridge Line 3 expansion that was supposed to come online in 2020, well, that capacity has already been spoken for by production increases that are in the market. So in 2020, production is already going to be at the mark where that pipeline is going to be full already. So it's not going to alleviate any of the pain we're seeing on our side. Then you add another piece to it and you go, okay, Trans Mountain Pipeline. Well, the Court of Appeals just nullified that. Whether your viewpoint is pro or against the pipeline, that is less so the point. From a business and growth standpoint for Canada, the government just needs to come out and have a clear vision and give that clear decision to everybody in Canada, so the market knows what to expect, and then you can kind of move on from there. This uncertainty and the flip flop that we're kind of living in is not good for the market, and that's what's getting beat up right now. The chart on the right there kind of shows you two things: Canadian production and pipeline capacity. As you can see, as I was talking about that 2020 mark, the production is still over pipeline capacity in Canada. Only until 2021 does it actually reverse. And these are contingent on a couple of things. So Canadian crude oil outlook, not so good until we get some other infrastructure changes that kind of and decisions that kind of come through. How has this impacted our price? Well, what WCS, Western Canadian Select, which is Canadian heavy oil, which usually trades at a discount to the price of oil that we see on the screen of around 20, maybe 25, 30% in really bad times, is now trading at a 50% discount, all-time lows. When the price of oil, so this is kind of where you see my ties back into that, where the refineries start to run for a lot longer. Well, that's why, because they were buying it so cheap from us. And the key takeaway here is, okay, if pipelines are full, how are these refineries in the south getting it? Which leads into the second piece, crude by rail. Crude by rail has had the largest amount of growth we've seen in quite some time. So the chart on the bottom there shows you essentially all the current pipelines, which equate to about 3.9 million barrels a day, then all the new pipelines that are expected to come online. That dotted line where it kind of goes above the pipeline space, that's being offset. That little piece there is going to be offset by crude by rail. That's where that starts to draw out. And so you don't see crude by rail going anywhere else until about that 2021 standpoint. The original forecast were to have crude by rail go up to about 250,000 barrels a day. We saw it peak over 300,000 already. Forecasted to go even more. The concern for crude by rail, the largest concern, is an environmental assessment. Pipeline leaks, you can cap the leak. A rail car goes over, you can't cap the rail car. You have to just clean the whole thing up. And when you have that many rail cars going down across the border, the inevitability is you're just increasing the chances. Rail cars do go down. It's just grain cars, so you never really hear about it in the news. So we're not really understanding the full assessment of what's going to happen there. So that's kind of what's on the crude oil side. From the natural gas side, I'm happy to actually give you guys a little bit of a more positive outlook for Canada on the other side. So the one key piece here is the LNG Canada project that recently got announced. That was the Shell and a couple Asian partners in there greenlighting the largest Canadian infrastructure project in history of $40 billion for the LNG. And what this essentially does, the big positive and green and growth outlook for us is it cuts transportation time down across Asia. So what happened, you have to ship it down south, then take it up to Tokyo. You're going from 20 days to 8 days. That's what that does. And it gives us a direct access to Asian markets. So long-term sustainability for gas, significantly more positive. Shell's capital budget programs has been heavily pushed towards the gas projects, as you guys saw with the LNG project. Other guys are going to follow suit. There's a play called the Duvernay asset play, where everybody's kind of focusing all their production on, where the gas market's kind of coming back around. That's long-term. So long-term, yes, there is positive outlook. That doesn't correlate directly with the $4 gas price we're seeing right now. That's more of a seasonality that we have all the time. As winter demand comes up, you need more heating, so you have to drive more gas from that. So that's just cyclical and seasonal. So crude oil, long-term, good. Canadian oil, until we have an infrastructure change, not so good. Gas is kind of beating crude oil in the infrastructure change. They're doing all the right moves to make sure we get access to other markets so we're not paired with U.S. production issues. And so that's kind of on the oil side, which let's segue into the U.S. economy now, especially, again, with what we're seeing in the markets. Well, I want to start with the corporate tax cuts that the government did down there, where they gave everybody tax cuts across the board and said, this is going to trickle down to the end consumer and everybody's going to love us. It's going to be great. We're going to create so much job growth. Well, what ended up actually happening is, no surprise, corporations held on to that money and they just did share repurchases, so another form of dividends. So investors got richer, consumers didn't. Consumers actually got hurt because high gas prices and high inflation, not so good for the consumer. So the chart on the right there will show you, on the right side is the real after-tax profits for corporations, and then the real disposable income for consumers on the left-hand side there. So minimal change year over year for consumers, but for corporations, a significant change. So investors keep getting more and more money in terms of dividends. Consumers, not so much. Now, as we kind of, James was talking about entering into some mature phases of the business cycle, you'll notice we don't actually predict a recession coming around. The market will have you believe significantly different. If we're watching BNN or you're watching all that red on your screen and the market's panicking, what is happening? The volatility isn't going to go away. One thing we need to hammer on, and then it's never more important than today's market, is the news and volatility is not going anywhere. So you need to focus on the fundamentals and the economic data and see what that decision shows. Well, as same with Canada, the U.S. tracking for 2.9% in terms of growth for 2018. Again, 2018 growth market. As it enters into this mature phase of the business cycle following Canada and the globe, it's still going to be growing. It's just going to be growing at a slower pace. So fundamentally, a recession is not in the cards because you still have growth across the board. Where the market is starting to get this volatility and a little bit of uncertainty as we kind of enter into this mature phase of the business cycle is a couple of things. It's, well, you've had housing kind of get hurt a little bit in the States, and the U.S. economy, it's been a combination of a couple of things here. You can jump. Yeah, there we go. So the U.S. economy, there's a couple of things that have essentially happened there. It's they overhauled their tax code, reduced their corporate tax profits, but they've also been doing quantitative easing and spending a lot of money for a long time. What that essentially does is you were cutting your revenue and how much is coming in. It's a double whammy. So as soon as you go into this 2021 business mature phase of the business cycle, if they don't mitigate that from spending to saving standpoint and ease into that, why we're forecasting the only 50-point hike next year for the Feds. If they just went straight from spending to the flipping the coin, that's going to hit their GDP 1.5%, just kind of year over year. And they don't want to do that because that's when the market's going to panic. And this is the numbers that the market's kind of going, okay, how is the Fed going to work going into 2020, 2021 as they've started to essentially hit the gas, and then as the economy started to do good, hit the gas harder, right? Now they need to slowly ease off rather than just let off the gas pedal altogether. Now, how that uncertainty is translated into the markets, that's what you guys have been seeing on the news right now. All the markets have had this period of volatility. It's not been a full correction. It's been the market's kind of taken, if you've been in the market, you've made good money, so it's a combination of profit taking, right? And a combination of people just kind of sitting on the sides going, let's take a breather, let's assess as we kind of enter into 2020, 2021 for the globe, what's going to happen. So that's kind of what's happening in the U.S. No different in Canada. Canada against U.S. U.S. has obviously outperformed Canada over the long run, over the duration of the bull market, led heavily by our infrastructure issues and lack of federal policy on our infrastructure issues. Lags our growth a little bit. The globe on the emerging market standpoint, different picture for emerging markets. They've essentially been in a protracted correction for quite some time. Emerging markets have had a hard time coming around from the growth standpoint. And so from a global growth, this is what, just tying it all back together, what James is saying here. Not only Canada, U.S., but the globe is already entering into the mature phase of the business cycle. We're a little bit later in the stage. So that's where you're going to see growth still grow, but at a slower pace. And then the one key piece to watch going forward is the trade war that the U.S. and China has kind of been going on. One thing, silver lining, and one grain of salt to take away with that one, he talks really tough against China, but his claim to fame is the stock market. Every time it goes higher, he takes credit for that one. Well, his incentive is now to come get the parties to the table because the stock market is getting beat up really, really bad. So just a little bit of take that with a grain of salt there, because he'll come in real tough and then say there was an amazing deal made, like the NAFTA USMCA, and then this is what ends up happening. So a lot of talk at the start, a lot of volatility at the start, followed by a lot more correction in norm status quo. The last piece, again, wouldn't be a presentation from our team without one of these yield curves in there. A yield curve just shows you time invested and the rate of return you're going to get for the time invested. The bottom line there is the Canada curve. The top line is U.S. What this just shows you is that there's no recession being predicted by the markets. Essentially, you're being compensated for taking what's called terms or investing for the long run. If this yield curve were to look the other way, it actually inverted. That's when the market's actually predicting a recession. I will say the yield curve doesn't change overnight. It's a really slow moving, really slow moving piece. And it's the best leading indicator for a recession. So no recession in the cards at this time. Now, we threw a lot at you guys in a really short period of time. So we'll stop for any questions if you guys have them.
Great. Thanks very much, gentlemen. So opportunity for questions. Absolutely, that was a fairly significant amount of information, but there might be some questions from council members, and we certainly want to have that opportunity to ask them. I see Councillor Bressie has a question.
Thank you, Mayor Given. I think I could probably guess the answer to this, but I don't want to assume it. I'm kind of curious if you have any input. A big topic discussion we're going to be having today or tomorrow is how to deal with debt in terms of taking it over shorter terms or taking it over longer terms. I'm curious, is there anything going on in the economy right now that we should be paying attention to as we're having that discussion?
Gentlemen?
Yes, a good question. I think it's come up a lot with cities in the province that we work with. One strategy we've been seeing a lot of municipalities do is use to fund projects, use a combination of reserve funds and debt. What I can tell you right now is just the trajectory of interest rates. If you can lock in low rates now, it's probably not a bad idea. And we're seeing a lot of municipalities do that, locking in sort of longer term fixed rate debt. And then if you can invest at higher rates, which you would expect over time as interest rates increase, you can earn higher investment returns than what you're paying on the debt. I hope that answers your question.
Just to add to that really quickly, from like James said, you always want to use a combination, and the direct reason why is yes, interest rates are really low for a long time. You also want to mitigate the impact of opportunity cost on the other side of it. So that's why you want to. It's less so a all or none decision. It's kind of always going to be that in between.
I see Councillor Plot.
Thanks, Mayor Gibbon. Just a question, I guess. I know we're talking about lots moving forward. You had a slide go up there, and I tried to take a picture of it really quick, but it was just kind of showing inflation, annual inflation rates. If I'm looking at this right, it looks like over the last 15 years, average annual inflation's probably been about 1.25%, 1.5%, somewhere in there for Alberta.
Maybe, sorry, Councillor, maybe we can find that slide.
Yeah, it was called annual inflation rates. It was the first presenter that did it. And the reason I'm asking about that is I can appreciate we're worried about where inflation's going. I guess what I'm trying to maybe hopefully remind us is what inflation's been and what we've been spending at that hasn't maybe quite paced inflation. So I think it was a slide either just before or just after this that kind of showed it was a year over year kind of a comparison. This one, yeah. So if you look from about 1995 on, there's a few that get above 2s, but most of them are hovering on that 1. You know, there's some zeros in there. So I don't know if you guys have a number of like the last, 15 years sort of thing, what the inflation's been, but my gut's saying it's been probably under 2 on average. I don't know if that's a fair assumption.
Good question. I mean, I think you can see there's a lot of bars there that are sort of around that 2% or just below it mark. There were some periods of almost deflation, especially just after the financial crisis. I think what I can say is with interest rates as low as they were for as long as they were, we would categorize it as sort of a period of low inflation, particularly the past 10 years. But I think somewhere in the high 1% is where it would fall. I can get you an exact number, though.
No, I appreciate that. And then my other, I guess I like the same charts as you guys. I was looking at a couple of the housing stats from CMHC. I'm just wondering if you guys have any concerns when, although our sales are up, that our average housing starts have literally plummeted and basically are non-existent. Is that a trend you guys continue to see, or is that just a Grande Prairie maybe problem, or is that a problem around the province, around the nation right now?
We saw that in another, we were in another council meeting yesterday, actually, and they had this similar statistic, actually. I think as long as the MLS sales continue trending higher, the housing permits are a bit of a mixed signal, so to speak. Okay. I'm surprised that it's that non-existent, and we don't have that data that you have there. But I would expect as people continue to migrate back to Alberta, if the employment prospects in Grande Prairie and Fort Mac regions continue to improve, you would expect people to want to move here and build homes, right? It's as simple as that. But it's something to watch for sure, especially if it's that low. Again, I haven't seen the numbers, but.
Okay, thank you.
Okay. Thanks, Councillor Platt. Any other questions, Council? Any other questions? Councillor O'Toole.
That was a very good presentation, and I was wondering if you could send us the presentation to us. Just
absolutely.
There's a lot of information there, and you did it in about 20 minutes. I got a real slow processor. I haven't got the Pentium Plus yet.
The timer scared us.
Thanks, Councillor O'Toole. Any other questions for our presenters this morning? There's only so often we get a chance to hear from our investment managers, and so certainly appreciate that opportunity. How is the city's portfolio doing? I know this is an economic forecast, but while we have you here, can you give us a general sense of the city's investment portfolio and what the current returns are and what they look like going forward?
Good question. So what's happened across the board over the past year, it didn't matter what you owned. If you left money in cash, you would have been eroded by inflation. If you bought bonds, as interest rates came up, what happens is in the interim, the prices will fall slightly. So what we've seen is and the keyword there is interim. It's a condition that typically lasts for about 6 months. Because we've locked in those rates of return, I'll give you a hypothetical example. Let's say we locked in a rate of return of 3% across the long-term portfolio. So those are fixed rates of return on the bonds that we earn no ifs, ands, or buts over time. So that should be the sort of the steady run rate of the portfolio. What happens in the interim is that if the prices fall slightly, which they have, your yields to maturity might have increased to say 3.5% going forward. So if you have a bad year for bonds, you necessarily have to have higher rates of return in future years. But yeah, it's a situation where the global bond market's been pretty much flat the past year. The good news is that it's generating a very high level of cash flow. Again, I don't have the numbers here because we weren't prepared for it. But one thing we did do to offset sort of the impact of rising rates is we've laddered the maturities, so we don't just have all the money in a five-year term. So as each year kind of goes by, we can take those maturities and reinvest them at higher rates. Bonds are kind of counterintuitive because if you have a year where the returns are less than your average yield, you should actually get happy because you can reinvest the coupons at higher interest rates. So our long run rate of return should actually increase going forward versus what our original expectations would have been when we first invested the funds. Hopefully that answers the question.
Yeah, generally, but I guess at a high order, what's your sense of what the city's current rate of return across the portfolio is?
Yield to maturity costs be around 3.25 right now.
Okay. Thank you, and appreciate sort of you answering that off the cuff. Any other questions for the delegation? If not, then thanks very much, gentlemen, for the national and global update on the economy, and we appreciate that. And I think we're going to move next to a little bit more of a local, regional focus, and we'll reorient ourselves towards Director Glavin. So thanks very much, gentlemen.
Thank you very much.
So we'll give Brian an opportunity to get seated and set at the front table. And so the intent is to have a little bit of literally a global look at the economy, a national look at factors that will ultimately drive Grande Prairie's economy or influence Grande Prairie's economy. And I think Deputy Director Glavin is going to zero in a little bit more on specific Grande Prairie context. Brian, welcome.
Thank you. A second to get the presentation up and good to go. All right, well, let's get started then. So we'll start off with some higher level local statistics, I suppose. So as a result of the most recent census that we did, the city is now the 5th largest city in the province, ahead of both Medicine Hat and St. Albert. So that could be a shot at Bob for leaving us for a smaller city. And then looking at the growth rate, we've actually had some pretty phenomenal growth rates in Grande Prairie over the last 18 years at 3.74%. To put that into context, that's about 68% faster than the provincial growth rate and 3 times the national growth rate for the country. Looking at median household incomes, right now we're sitting at a little over $105,000. That is about 12.5% above the provincial average and a full 50% higher than the Canadian average. As well, we continue to be one of the youngest cities in Canada with a median age of 31.9. The average house price for last year is sitting about $294,000. This year we're sitting about $304,000. And just going on with the theme of how we compare provincially and nationally, we're about 22% lower than the Alberta average and 37.5% lower than the Canadian average for houses. And when you look at that from an income perspective, housing affordability is quite affordable in the Grande Prairie and Grande Prairie region, given our high incomes and relatively low cost of housing. And there's a caveat on the housing that those are resale numbers. Those include new home sales, but they are not only new home sales. So if you look at new home sales, they are higher than that. They're closer to, I think, 380 to 400 for a 2-car garage, 1,800 square foot house, and those are very ballpark. This is just a representation of where we sit in the order of cities in the province right now. On the left-hand side and on the right-hand side, we're looking at some of the counties throughout the province. And you can see the city and the county both sit at number 5. So looking at population growth and how the city grows, how the region grows, where people come from, where they go. We went back to 2009 here as we were kind of coming out of the financial recession back in 2008. And you'll notice that there's not a single year if you look at the red line, that we had negative population growth. So even when you're going to 2015, 16, 16, 17, we still see positive population growth. Now, not all elements or all components of the population grew. You can see on the bottom, the lighter blue color is interprovincial migration. This is when you have people that are going to a different province. They're moving back to British Columbia, or they're moving to British Columbia or any of the other provinces within Canada. And then on the intra-provincial migration side, in the dark blue number, this is anybody who's moving within the province. So if you're in Grande Prairie and you move to High Level or you move to Calgary, you would be captured in that intra-provincial migration. So one of the things we noticed digging into the numbers a little bit on the intra-provincial migration side is that it tends to be female and it tends to be under 30. That's not true for everybody, but my hypothesis is that's largely education migration that we're seeing with that. So it'll be interesting to test that hypothesis when we have the Grande Prairie University or Grande Prairie Regional College convert to a university, if we see some of that trend reverse, where we actually might see some intra-provincial migration coming to the city as opposed to going to Edmonton, Calgary, or beyond. So looking at home prices and unit sales, so you can see right now on the bars are the unit sales, so how many sales we've had year to date to October, and all of the numbers are year to date numbers for October for each of the respective years. So right now we're on pace for roughly 2012 this year, with our average home prices on the resale market sitting a little above $300,000. And this is the more painful number for some of the people in the room, especially Councillor Plot, I would say, with the new home or new starts. We're not seeing them return to levels that we had seen in past recoveries. You know, when we're looking at some of the numbers, you're seeing the rental vacancy rate sit at 4.9% in 2017. That's an October number. It's done once a year by CMHC. We're expecting the new October numbers to come out early December. Talking to some of the larger landlords within the city, we're expecting that number to be somewhere under 3%. Typically, a 3 to 5% vacancy rate is considered to be a healthy vacancy rate for the market. So right now, we're sitting on the high end of healthy at 4.9. Under 3, you tend to see more product come online to satisfy demand. So if we are truly sitting at 3 or less, we should start seeing some of that product come online within the next year. Looking at building permits, this is a messy, little bit of a messy bar chart here. But what you're seeing is 2015, 16, 17, and 18. And right now we're sitting about 20% or so above 2017 numbers. So I think this year we're at about $155 million of construction and 927 building permits for the year. And versus 905 building permits last year and 135 million of construction. But if you look back a little bit further on the value of construction that we've seen in the past, so 2015, for example, at this time of the year, we would be looking at about $220 million of construction. 2014, which isn't on this chart, but I think we were around about $250 million in 2014 at the same period. This is kind of a recap of where we were looking with the median household income, and this looks a little bit more across the country, where you can see, you know, kind of a low in Cape Breton of just over or just under $54,000 in their average or median household income, and then with Grande Prairie being at the top of this chart. If you can find other areas of the country that do have higher median household incomes. There's some select neighborhoods in Toronto and Vancouver that have higher median household incomes. Wood Buffalo has higher median household incomes, but in general, it holds relatively. I'll say that Grande Prairie is one of the best places in the entire country for median household income. Looking at the labor force and the unemployment, this isn't one of my favorite data sets, just given that it covers basically all of Western Alberta from Athabasca Athabasca West, all the way up to the Northwest Territories and essentially down to Southern Alberta. So to give you a little bit of perspective, at one point we were able to get Grande Prairie specific numbers, and then there was a change with the federal government that they made the area bigger, but they didn't increase the amount of the sample size, so how many people they were actually surveying as part of this. So the numbers became useless to us, but if you take what the trend was historically, we were usually 1 to 2% below whatever the reported rate was. So if we were reporting 5.3%, Grande Prairie was typically sitting at 3.3 to 4.3% in the unemployment rate. So given that we're at 5.3 now, we're probably somewhere around that 4% rate for the unemployment rate, plus or minus. This is just a kind of a graphic representation of the diversity of the employment in the region. So you can see it's a little counterintuitive here. It goes counterclockwise from the top. So you see 2% is the information, cultural, recreation. And then the 15% in yellow is forestry, fishing, mining, oil and gas. So obviously the forestry, mining, gas, oil and gas sectors are the largest in our region. But when you start looking at, wholesale and retail trade, so this is any other retail sector, this is everything from your Northern Metallic to Canadian Tire and everything in between, is the second largest component of our economy, followed by healthcare, social assistance, and then we get into construction, transportation, warehousing, and so on and so forth. So this is a table looking at our occupant or vacancy rates for commercial property throughout the city over the last 5 years. And you can see the trend there. It follows the economy almost to a T. But we're seeing some pretty significant improvements in 2018, especially in the office and industrial markets. The office market in 2017 was almost 9.6% vacancy. Right now we're sitting at about 5.5%, and that's about $112,000 or 112,000 square foot of absorption that we've had over the last year. So between people leaving their offices and people moving in, that's almost a 214 place full of office, to put it into a scale. When you move on to industrial, we've had over 150,000 square feet of absorption over the last year. And that's moved us significantly towards the low end of what would be a healthy vacancy, and we should start to see some of that product come on the market to satisfy some of the new demand. The retail took a bit of a turn the other way, and that's almost completely due to the Sears Center. With Sears leaving, that was 110,000 square feet of retail that is newly vacant. Some of the other ones that are notable in counting towards absorption now would be the former Wholesale Sports, which is currently under renovation to become Planet Fitness, I believe. And then the PV Mart building, which I think just missed the survey here, but will count towards absorption in the next round of this next year. So this, moving on here, we're moving kind of back into retail. This is a graphical representation of the trading areas that the city has. This is relatively conservative. It goes up a little bit north of High Level, and then up to around Fort Nelson in the north on the west side, east to Whitecourt, and south down to the Grand Cache area. So PTA is the primary trading area, STA is a secondary trading area. So essentially how you interpret that is primary trading area are people who use you as their primary place to go shopping. May not include groceries. There's a bit of a spectrum as you get further north or to the fringes of the primary trading area. It can act a little bit more like the secondary and vice versa. But these are the people who form a lot of the core demand for the retail that you have in the city. The secondary areas are people who don't come here typically for groceries. They might load up when they come to Costco, but typically they're getting their groceries at a different location. But a lot of their larger or more specialty purchases will be done in Grande Prairie. So this represents about 280,000 people. If you were to look at Grande Prairie as a standalone market, Grande Prairie only justifies about 1.8 million square feet of retail. We have about 4.2 million square feet of retail right now, which is more than 2 times that amount, which is indicative of how big of the trading area is. We're and kind of moving on here with the amount of spending that we see. That 4.06, this is a 2016 number. All of these numbers you see here, 2016, they're based on the retail market analysis we did at that time. We'll have a new retail market analysis done here, I think next month they start their work for 2018. So one of the things when we first reported on the retail market analysis was the residual retail demand, which is this 958,000 square feet of residual demand. And I remember we fielded a few questions around how are we ever going to have another million square feet of retail come to the city. Well, next year alone, you're going to have probably 300,000+ square feet, and I'll kind of go into that right now, where you've got, just on this page, you've got 313,000 square feet of retail that is going to open up next year in the city, with Canadian Tire being the largest single-story Canadian Tire in Canada. The only bigger Canadian Tire is one in South Common, which is a two-story, which is one that they actually didn't intend to have a two-story, but they chose to pilot a two-story in South Commons. And then you have Windsor Ford as the largest Ford dealership in Canada at 130,000 square feet. So obviously these are just two projects, but then you have other projects in Trader Ridge that are under construction right now. You have other projects in Westgate West that are under construction right now that'll all add to this square footage for 2019. The Grande Prairie Regional Hospital, when it's built, will be a significant economic generator for the city. It's expected that the services and new jobs at the hospital will represent a $276 million increase to our annual GDP. It'll also be, I think, the largest building in the city at 685,000 square feet. The Highway 43 bypass is scheduled to be complete in 2019. Upon completion, the city will be transferred ownership of the existing Highway 43 within city limits, which you'll hear about more likely tomorrow on the infrastructure presentation. We don't have firm numbers as far as how much diversion we'll see of traffic on this highway. It's been suggested around 5,000 vehicles a day will utilize the highway in some way, shape, or form, but we're not 100% sure what this is going to look like. On the Tri-Municipal Industrial Park Initiative, the city working with both the MD and the County of Grande Prairie, we continue to work with our contractor to complete the area structure plan for this area. I believe we're targeting around February to have, or being close to being done, that portion. This will open up 335 square kilometers of land for potential development. Although not all of the area is developable, there's a lot of water in areas that are not suitable for development in there. We've identified a number of sites that can be used for petrochemical development or any other large-scale industrial that the partnership deems fit. Some of the other exciting new projects that we're seeing, kind of in the same vein as TMIP, is the Nautical Energy project that was announced a little over a month ago for a $2 billion methanol plant to be built on the International Paper site south of the city. This will be a significant increase in demand for natural gas at 300 million square feet a day in our region, and it'll produce over 3 million tons of methanol at full production. They're targeting 2019 as their final investment decision. So this hasn't been sanctioned yet from the company to go ahead for construction, but if it does receive its final investment decision in 2019, they're anticipating a 2021 completion date. Some other notable projects that have been announced recently would be the TransCanada $1.5 billion expansion of the Nova gas transmission system. This is largely in our area and will help contribute towards the LNG Canada development that's happening in Kitimat. That's next on the list at $40 billion. So what do you get for $40 billion? You get about 22% of the natural gas production of Canada. That's what this project represents. And the vast majority, if not all of that production, is going to come from northwestern Alberta and northeastern BC. So whether or not it's a full 22% increase in production for Canada, or whether we're diverting some of the gas from this area from heading east and instead heading it, for it to head west, we're not sure yet. But it is no doubt a very significant investment for our region and for the country. Similarly, with the next three investments here with Pembina and a pipeline expansion, Keyera Corp with gas plant, and another gas plant with Tidewater. These are all tying into production and pipeline capacity, essentially. As you build pipeline capacity and production, you need more gas plants to handle the gas in order to strip the liquids and to put the gas into a sales gas specification for it to travel to market. So kind of moving in with our theme here on oil and gas. The next slide after this, I'm going to show you producer financials, and these financials are for the drilling and facilities budgets for Montney-focused producers. So these are producers that are largely just producing in the Grande Prairie area. It's not indicative of all of the activity that's occurring, but it's the only stuff that we can get our hands on, because if you're a large multinational company like Shell, you don't strip it out to the Montney level or the Duvernay level or any of the other fields that you're in. It's just an overall drilling and facilities budget, as opposed to the next companies you'll see, which are just in our area. There's a lot of volatility in the different producer budgets, but the bottom line number is kind of indicative of some of the activity that we're seeing in the area. So you can see Seven Generations continues to be the largest spender, almost $1 billion in 2018 on the drilling side, and then close to $500 million on facilities. And then as you move down the list, you can see who's doing what, and then there's a percentage difference between now and 2014. But one of the interesting numbers is that right now we're 9.3% above 2014 numbers for all of these Montney-focused producers. And then on the facilities side, we're a little over 11% above 2014 levels, which matches some of the traffic numbers that we're seeing in our area right now that are suggesting that we are busier than 2014. This is just looking at well licenses. So you can see that 2014 versus now, there's 314 wells difference in the license. However, you can strip out about 250 of those wells from 2014 because those are bitumen licenses. So anything to do with Shell, Baytex, or Advantage Oil and Gas were all bitumen focused in the Peace River area. Since Shell abandoned the Carmen Creek project, all of that drilling has essentially disappeared. There's next to no bitumen drilling occurring in that area anymore, and that's why you don't see any of that or those companies reflected in the stats for 2018 drill licenses. Versus 2017 at the same time, we were sitting at about 760 licenses, so we're trending a little above last year. This is what it looks like separated out by year and commodity. With oil and gas, you can see that the oil licenses are increasing, and that's partially due to the price of oil, but it's also partially due to a change in licensing with the Alberta Energy Regulator. Some of the liquids-focused wells are now classified as oil wells, as opposed to they used to be classified as natural gas wells. So there is a little bit of the numbers aren't as clear-cut as the graph would suggest, but this is the new classification that's being used by the Alberta Energy Regulator. So this here is the drilling completions for the area. This is the conversion of the licenses to actual work. So you can get a license and you can never drill a well if you chose to never drill a well. The completions are the actual drilling of the wells, and there's a few different classifications down here, but ultimately they all lead to a well being drilled. Some were just started and they were abandoned, and then they were re-entered, or they were resumed within the period of time that the license allowed, and ultimately the wells were completed. This is another interesting chart here that shows the overdimensional vehicle traffic. So this is anything that is too high or too wide that requires a pilot truck or requires us to go out and turn the lights. So one of the things that has generated some work for the Transportation Department over the last 2 years, and some overtime, as you've probably seen in their budget, has been every time these overdimensional loads come through, we have to go on 116th Street, which is the high load corridor, and we have to physically turn the lights. So they go and they attach a really long steel bar to the lights, and a couple guys turn the lights physically, and the truck goes through, and then we turn the lights back and it resumes normal operation. So looking at, this is Highway 40 just south of the city, between the city limits and the correction line. Average two-way traffic on Highway 40. Last year we were at this time, and so actually 2014, 15, 16, and 17 are full years, and 2018 is up to September. We anticipate September will likely be above 2017, as we typically see a little higher traffic volumes on that road in the winter as activity picks up. But right now we are at essentially record levels on Highway 40 that have now surpassed the 2014 levels of activity on Highway 40. Looking at travel and occupancy, which is also intrinsically linked to oil and gas activity. Currently, we have 3,400 hotel rooms within the city. That's more than the city of Red Deer has. for some context on that, as of August, our hotel occupancy rate was 64%, which was fourth in the province, behind only the Rocky Mountain destinations of Canmore, Banff, and Jasper. Up until summer, we were second, behind only Banff. As those areas go into their shoulder season here, we anticipate we'll likely finish in the top 3 for occupancy in the city for the year. And just kind of to recap here, looking at the impact of forestry on our area, our region produces 40% of all of Alberta's pulp and 50% of the timber. And there are 3,300 people that are either directly or indirectly employed in the industry within the Grande Prairie area. And on the agricultural side, we're the second largest crop producing region of Alberta, with 3.9 million of productive acres of agricultural land. And with that, I'll be happy to take any questions.
Thanks very much, Mr. Glavin. Questions on our more locally focused economic indicators? Councillor Palat.
Thanks, Mayor Given. Good presentation, Brian. Lots of data. Nice to see that the city's definitely heading in the right direction, and there's lots of positives for our region, so that's always good. Just a couple questions. I know that you tried to have the one slide that kind of unfortunately had the Alberta numbers or the regional numbers for kind of employment, but what do we think in our city we have for overall employment? Are we in that 40 to 45,000 kind of range, or would we have a kind of a number on that?
Be a bit of a thumb suck for me now, but you'd be in the ballpark at 40-ish thousand.
Okay.
People that would be over the age of 18, not necessarily in the workforce, and then you'd have any retirees that would be stripped out of that. But if that's something that council would like to see, I'd be happy to provide that information. We could get that in relatively short order.
No, I'm just more trying to get a hypothetical, I guess, on it. It would be a nice data to have someday, but it's not. I'm sure we have more pressing things. I'm just kind of curious. The other thing with all this new projected growth in 2019, what new roads or infrastructure, anything will the city have to do to attract any of that?
Right now, we have a pretty significant amount of service land within Grande Prairie, or serviceable land within Grande Prairie, and we have our core arterial roads developed. So depending on where the growth occurred, you may see some twinning projects that may be warranted along 116th Street and potentially 132nd Avenue if you're looking out a little bit further, within the next 5 years or so. Obviously, that all depends on when and where the development occurs. But as far as core infrastructure, the city invested heavily in the West Sewer Trunk along 116th Street. That opened up about 1,600 acres of developable land in that corridor. And on 132nd in the northeast, we have 3/4 east of the Albanetti Industrial Park that are serviceable with the 88th Street sewer trunk in that area, as well as an additional quarter section of residential just north of Copperwood.
Okay. So I guess, for the Canadian Tires and the Windsor Fords, the big things that are coming, the infrastructure is already in the ground. And for the stuff, if we do grow, we're already ready for it, it sounds like.
Generally speaking, yes.
Okay, thank you.
Councillor Platt, any other questions for Mr. Glavin? Brian, I had one, the slide that you had around population growth and sort of interprovincial, provincial migration. I was curious if you could just refocus in a little bit, because it seemed to me that the natural growth didn't show the ups and downs. And is there sort of any interpretation of what that means, of why that sort of green section was getting larger, consistently getting larger over time?
Yeah, so we saw a huge amount of population growth kind of in the mid-2000s. And as those people settled down, became of age to have children, we saw a pretty significant spike in births following that time of migration that we had from kind of 2003 to 2007. I think we, just in the city alone, we saw 15,000 or so people move to the area. As well, what we're seeing too is we're seeing more capacity on the elder care in the region. So when you have, and that actually counts theoretically against natural population growth. Natural population growth is births less deaths, so it's a net number. But what we're seeing is an increased birth rate that's been relatively sustained. So when you see a big jump in 2012, that was a regional jump that we saw. I think we went from somewhere around I can't remember the exact numbers now, but I think it was 2,000 to 2,500 or something in that general scale. And we've sustained that birth rate, and we're increasing that birth rate every year. But we have a significantly larger population that we're building on that birth rate. And as we are a relatively young region, we generate a lot of babies at the moment.
So I mean, as a broad generalization, we have more people than we had before. They continue to be relatively young compared to provincial national averages. And so is it an unreasonable assumption that they're going to continue to have children because they're all sort of family starting age?
It seems reasonable that we can assume that we're going to continue with this rate of natural growth.
Okay. Any other questions for Mr. Glavin? I don't see anybody else in the queue. Last chance, council? No? Okay, I don't see anybody else in the queue. So we were scheduled, thanks very much, Mr. Glavin. Thanks for the presentation. So we were scheduled to do a bit of a transition around 10:30. We're a little bit ahead of schedule, but I'd suggest that the next step is to do an introduction and process overview of sort of the next steps. And so now might be a time to take a bit of a break. We'll do that until, let's say we'll go until about 10:30. It's about 10 after 10 now. We'll go until about 10:30, and we'll come back for an introduction from Mr. Galante, and then an introduction of our process from here through the rest of the budget discussions, and we'll start that at about 10:30.